bio in 2022, and in today's tutorial it happens to be the continuation of the course ACC102, and I'm optimistic that we can call it a wrap for the course today. All right, because we've come a long way, and I would have had the course finish this course earlier so we can start taking our revision classes, but nevertheless, we are going to be taking the course today. Today's been said, let's go straight into it. Okay, good evening, everyone. All right, good evening, Miss Tasha. It's good to have you on board. I welcome you all on board. And just like we know how it's been done, it's a class. We're expected to make it lively. All right, we're expected to respond accordingly. And good evening. You're welcome. You're welcome. Okay. So according to the thumbnail, it says suspense account. All right. So we're talking about what it means by suspense account and why it's so important, why we even talking about it. All right. All of that we'll be discussing in a moment. Now, the course is ACC. All right. ACC102. All right. That's the course ACC102. And we're going to be talking about what it means by suspense account. Now, without further ado, when we say suspense account, okay, we are simply referring to that account that is created, the account responsible, all right, for one thing. Suspense account. This is an account responsible for one thing. And that thing is whenever the trial balance, all right, does not have an accurate balances, all right, then the suspense account comes in. Look at what it says here. Listen to this. It says, when a trial balance does not, all right, when a trial balance is not balanced and there is no time or it is not convenient to immediately locate the correct answers or the correct balances, all right, of the errors because the final accounts are urgently required, then the trial balance can be made to be balanced by inserting the balance figure and describing it in a suspense account. All right, this is the account inserted when the trial balance is not balanced. There you have your suspense account, giving the details why the trial balance is not balanced. All right, just like we said earlier, you can figure out where the error is at the time where the final accounts are urgently required. Then you have to insert a suspense account as to when you become enough to find out why the trial balance is not balanced. All right. Now, the final account represents the presentation. All right. You know, we're talking about the final account. And according to what it means the representation of financial information for a particular period. All right. Final account representation. The representation of financial information. Okay, the representation of financial information for a particular period. Okay, the representation of financial information, okay, for a particular period or year all right, to the users of financial report. To the users of financial report. So we have that as that. Now, the final account of a sole trader basically consists of what we refer to statement of profit and loss and statement of financial position. All right. So it is what it is, and basically, we're going to be talking about what it means by. All right, we're going to be discussing some certain terminologies and what they represent or stand for. All right. Now, to start with, we have sales. All right. Sales is something we are very used to hearing, if I'm not mistaken. All right. Something we are very used to hearing from time to time. All right. Sales, sales, sales. Now, sales represent the total of all credits and cash sales made to a third party. All right. So we have sales, total of what? Both cash, all right, and credit sales of all cash and credit sales. Okay, made to a third party. So when we say sales now, it's a thing that happens, all right, it's expected to happen between parties. Are we together? There's a giver and there's a receiver. All right. So it could be you are giving in credit, or you are receiving in credit, or you are selling, all right, in credit, or you are selling in cash. All right. It could be you are paying, you are purchasing, to the other end, you are receiving, you are paying in cash. That means the person selling is receiving in cash. All right. But for the person receiving, if you are purchasing on credit, that means the person selling is selling on credit. All right. So it's basically two things: cash or credits. All right, cash or credit. Are we together? So, total of all cash and credit sales, all right, made to a third party, then we have that as sales. Now, we also have what we refer to as return inward. All right, I think we talked about this in our last class when we talk about return inward as goods previously sold to customer but were later returned. All right, later returned. Now, there's something called the opening stock. Now, the opening stock are said to be the value, the opening stocks, they are said to be value of stock of goods meant for sales that are available within the business at the beginning. That's what we call them opening. All right, opening stocks. So, note the key point here: value of stock of goods. Value of stock of goods available, not at the end. If it's at the end now, it's a different thing. But it is available at what we usually refer to is when we use certain terminologies, we say available at the beginning of a financial period. All right, but that is a little bit high for this level. All right, so at this level, we refer to it as the opening. Is referred to as the value of stock of goods that is available or meant for sale at the beginning of the accounting period. Value of stock of goods, availability is very important. Available for sale, all right, at the beginning of of the accounting year. All right, available for sale at the beginning. Please note that. So now we have availability. We don't have much time, but just note all these things: beginning, all right, and value. Note all the key points. Please, as you join the stream, if you like to smash like button, ensure you smash like button. All right, so we have that as that. Now, this is basically the opposite of closing stock. All right, as far as closing stock is concerned, closing stock represents the value of stock of goods that are meant for sale, which a business has at the end. All right, the difference here is that this is at the beginning, it's at the end. So we have that as that. Now, there's something called gross profits. Right? When we say gross profit, it is said to be the profit realized on trading activities. All right? These trading activities minus expenses incurred. All right? All your trading activities, all the profits, all the incomes, all the earnings, minus after you have removed or after you must have removed all your expenses incurred. All right. When we say expenses incurred now, just let's use this class for example. All right. To get this class, all right, to get on the live stream, you need to fix certain things like the utility bill, certain things. If there is no electricity bill, there is no electricity, we need to get gas in the generator, all that expenses. All right. Talking about the markers we use, talking about the system, talking about the ring light, the tripod, the microphone, everything, expenses incurred to get all these things set. All right. After removing all these expenses, all right, then we talk about the money left, the earnings left. Then we refer to that as gross profits. So we have, so let's just put that down. So we have gross profits. This is the profit realized on trading. Profit realized on trading activities. All right. After, or let's just put expenses incurred. Expenses incurred. All right. Minus expenses incurred. So we have that as that. So now we also have what we call net profit. As far as net profit is concerned, it is the profit derived after all expenses and cost of sales have been deducted from the net income. All right. So there's a net income, there's a net profit. Are we together? So now, before we talk about net profit, then we have to talk about net income. Now, when we say net income, this is the amount of money, all right, amount of income a business has left after subtracting all expenses from its revenue. Okay, so it's total revenue minus total expenses. Okay, so we have amount of money a business has left after subtracting all of its expenses. Income left after subtracting all expenses, all right, from revenue. Okay. So we have that as that. So now, speaking of the net income, the net profit, all right, they can be synonymously, all right, used. Okay. So we have net profit, according to what we have here, it is the profit derived after all expenses and costs have been deducted from the net income. speaking of sales and other income. All right, so net income, net profit, they can be synonymously used. So we have that as well. We talked about assets already, if I'm not mistaken, but we can just quickly brush on that. Now, when we say assets, they are valuables, possessions, claims, properties, all right, belonging to a business. All right, assets has the feature of providing, all right, more, all right, the potentials of providing more income or revenue. Okay, so we have that as that. Now we also have types of assets whereby we have the non-current assets and we have the current assets. As far as the non-current asset is concerned, these are companies' tangible assets that are expected to be used in the organization for, all right, many years. So what made the non-current asset different from current asset is the longevity. All right, longevity. So we have current assets. So we have longevity. All right. Let's put this with long lifespan. Long lifespan. Then we have examples of these are fittings, land, building, furniture. All right. Fittings, all right, land, buildings, all right, and the like. Then we have, and this is non-current actually. Then we have current assets. Here, very short, all right, usually within a year, all right, depending on the kind of asset, but usually within a year. So we have the likes of debtors, stocks, bank balance, cash in hand, and prepayments. All right, short lifespan, where we have bank, drafts, all right, we have prepayments, all right, we have cash at hand, and the likes, or cash in hand, either ways. So we have that as that. And we also have what we call tangible and intangible assets. As far as intangible assets are concerned, we are talking about copyrights. You need to be on YouTube to understand what it really means by copyright. If you use other person's contents without their permission or their go ahead, you'll be flanked. All right, that is some serious copyright infringement. All right, it's an asset, even though it's not physical. All right, it's not physical like building or land that you can touch or hold on to. All right, but things like copyrights, the likes of copyrights, the likes of goodwill, you can use somebody's name without his permission or his go ahead. Likes of trademarks, patent rights, all these are intangible assets, meaning that you cannot hold on to them, like they are not physical. They don't have forms or shape, but they are in existence. So we have that as that. So we can consider tangible assets beyond these slides that we can touch, and they have physical forms. So we have investments. All right. When we talk about investment, these are ownership interests. All right. There are ownership interests a company has in another organization. All right. Speaking of investment, we're talking about ownership interest. All right. So it might not really be where ownership interest goes a long way. Right. But what you need to understand about investment is basically just keeping money aside, all right, acquire certain things that will, on the long run, produce more, all right, resources. All right. So let's just go for, all right, a precise definition, which is that's the ownership interests. Okay, the ownership interests a company has, a company or an organization has in another organization. A company has in another organization. Okay, so we have that as that. Now we also have liabilities. These are financial obligations, as we all know. That's the opposite of assets. These obligations business has in favor of outsiders. They are not owed to individuals and organizations. All right. Like we have non-current liabilities and we have the non-current, just opposite of current and non-current assets, where we have the lifespan of both liabilities. A good example of non-current liabilities are bank loan, mortgage loan. Mortgage loan can take up to 10 years, depending on the contract. And current liabilities are accruals, bank overdrafts, credit. No creditor will allow you hold for up to 2 years, although it depends, but basically it's usually within the year. So we have that as that. Now there's something called owner's equity. It's otherwise known as capital. Owner's equity, all right, otherwise known as capital. And when we say owner's equity, it is the initial investment, all right, of the business owner in a company. Initial investment. Okay, initial investment of the business owner of the business owner in a company. So we have that as that. And talk about capital. The formula for calculating capital is total assets minus total liability. All right, so owner's equity slash capital equals total assets minus total liability. And we have that as that. So very quickly, let's talk about what it means by okay. Let's talk about what it means by bank reconciliation statement. All right, it's a very straightforward concept. When we say bank reconciliation statement, it is a process, all right, of making the balance on the bank column of a cash book to agree with the balance on the bank statement received from the bank. All right, the reconciliation here stands for trying to reconcile balances between what you have here and what you have stated on the bank statement. All right, so we have that as that. I think we've actually gone far and I've done a lot. And before we call it wrap for today, there's something called the break-even point, which is the BEP. All right, BEP. Now, the break-even point is determined as the point, okay, the point where total income from sales equals total income from sales equals total expenses. Then we have the break-even point. All right. So thank you very much, everyone. I believe you'll be able to gain something in today's class. And for those of us who are not in the private class, it might interest you to, all right, join the private class if you can still join. Though we encourage you to just wait till next semester and join as early as possible so that we can have all these classes together as early as possible. So we can have enough time to walk through all the classes. Nevertheless, the exam is fast approaching and I will you lay your hand on what we refer to as the exam practice questions. They are highly essential for exam preparation. You want to get them and exam keynotes as well. Just need to go to our official website. Although the exam keynotes are not yet available, but they will be soon. Go to our official website www.tutorial.net. You find the WhatsApp button in the top right hand corner. Smash it and take you to our DM, make your inquiries, and we can get you these exam practice questions and keynotes as well. Thank you very much, everyone. Just before we call you up for tonight, let's take home these assignments. All right, we have assignment. Now it says here, in your own, in your, in your words, explain the differences between return inward and return outward, carriage inward and carriage outward. Okay, return inward and return outward, carriage inward and carriage outward. All right. So thank you very much, everyone. Do you have a wonderful evening? You have revision tonight. GS, I think we have Echo 121 and Echo 122. I think for this department is Echo 122. Don't miss out. It's happening after this class. Do have a wonderful evening and bye for now.